Hello, welcome to the Sunlight Podcast. Today, I'm going to be doing part 2 of my breakdown on estimated quarterly taxes. This was requested by one of my listeners, Staley. So shout out to Staley. You're getting 2 episodes because of your request, which is such a good one. I mentioned before that I actually talk about estimated quarterly taxes so much inside my program and inside the lectures that I give to universities and professional development groups that I kind of forgot to talk about it on the podcast. So see, this is why I need you. So if you're listening and you're like, why doesn't she talk about blah, blah, blah? Send me a DM. I need your help to remember. So tell me what you want me to cover. If there is a burning question that you have, I want to just let you know that almost every single time someone has sent me a DM requesting a topic, I have agreed and I have made the episode. So your chances are really, really good. All right, so on with the episode. So last week we talked about estimated quarterly taxes. We talked about what the deadlines are, kind of the basics about how they work. Today, I want to talk about why people misunderstand them. Okay, so here's what I see, because, like when I'm doing people's taxes, here's what I see. I will see a client come to me for the first time, and I will see that, they owe a substantial amount of tax. They may be doing, part 1 of the right thing and setting aside money to pay their taxes, but they are way over the threshold where they're allowed to wait and pay just one tax bill April 15th. They're actually completely required to be paying quarterly, but they don't realize it, or they don't think that this applies to them. And so it is my unfortunate job in that scenario to let them know that they do, in fact, need to be paying quarterly and not annually. And so a lot of times how this conversation goes is I say to them, hey, your tax bill is like, $15,000. This is much bigger than the IRS allows you to be paying once per year. You need to be paying quarterly taxes. So let's talk about how to do that. And they say, no, yeah, but I just pay annually. And I say, yes, I can see that you have been paying annually, and you have this penalties and interest line calculating on all the prior year tax returns that you have brought to me from some other place. But the reason that you're paying this, $500 to $1,000 penalties and interest every year is because you're not doing the quarterly payments that you are required to be doing. So let's talk about how we move you from this habit of only paying at the end of the year, building up penalties and interest, and moving on to paying quarterly, which is what you need to be doing. So that's what I see happening. Now, if this is you, I don't want you to feel bad. The fact is, most accountants during tax season are so busy. They do not have the time to slow down. I think they should. I think it is actually really important that accountants explain to their clients what is going on. And I would say it is a bit of a red flag if your accountant is not willing to explain things to you that you don't understand. Certainly if you are in the system, if you are mandated to be paying quarterly and you haven't been, and your accountant is not having a real conversation with you about that, that's a really big deal. That's a red flag to me. So you may need to be paying quarterly. And so let's get you feeling a little more comfortable with that system. I know a lot of us feel like, well, how do I get started? I need someone to tell me what to do, because it feels scary. It feels intimidating. It's the IRS, and you don't want to do it wrong, right? And it's frankly not at all intuitive how you make your payments. Okay, so I'm going to break that down for you today so that hopefully by the end of this episode, you feel a lot more comfortable knowing what you need to do and how to do it. Okay. All right. The other mindset issue that I see get in the way when it comes to people getting started making their estimated quarterly tax payments is actually the issue of perfectionism. I did a whole episode on perfectionism earlier, and we'll link to that in the show notes. It's a good one. But here's where I see perfectionism actually stepping in and stopping people from paying their quarterly taxes. I think what happens is a lot of us we really care about doing the right thing, actually. And we are so concerned about getting it right that we don't want to be wrong. We don't want to come up with the wrong number or do it incorrectly. So, and I also understand that, the IRS is scary, right? They have the power to throw you in jail, to lien your property, to garnish your wages. So they have a lot of powers, and it can feel scary to do the wrong thing when it comes to the IRS, right? So we kind of get all up in our heads and we're like, I can't figure out the exact number, so I'm just going to do nothing. So that's the problem. It's the doing nothing. I just want to be here to really coach you through this funny, counterintuitive thing, which is that estimated quarterly taxes are just that. They are estimates. You are not going to be able to calculate the exactly correct number. You couldn't do it if you tried. The only way you could calculate your estimated quarterly taxes correctly to the dollar is if you had a crystal ball and you knew exactly what was going to happen all the way through the rest of the year, exactly what income was going to come in, exactly what life circumstances were going to happen to you that might raise or lower your tax obligation. And you'd also have to have a crystal ball that would talk about what Congress was going to pass and if new tax credits were going to apply to you or old ones are going to be extended that you thought would be expired, because this also happens every December. And you're not a bad guy and you're not a dummy for not being able to know what Congress is going to do, right? I think at least that one we can all agree. Yeah, we have no idea. So release yourself. I hope to be the tax fairy for you right now and just say, please release yourself. This isn't a place for perfection. In fact, this is a place where perfection really gets in your way. What you want to do is do something that's B+, good enough. That's all you need. Okay. So let's get a little more specific about what this means. Here's the reason I think that people fundamentally misunderstand estimated quarterly taxes. Okay. So our tax system, when you file your taxes, now you only file one time per year, right? Your annual tax filing, that's the information part. When we say filing, we mean the information. You prepare a tax return. You only need to do that one time per year. That is due April 15th every year, unless it's over a weekend, and then you get a couple extra days. And then you can get an automatic extension of time to file. Note, I'm only saying file, not pay. You get an extension of time to file for 6 months to October 15th if you apply for an extension before the tax deadline. Okay, so that's filing. Paying is always due April 15th. There's no extension. There's no extension ever. So a lot of people think if they get an extension on their taxes that they got an extension on the payment deadline, and you didn't. So payment April 15th all the time every year. Filing April 15th or a 6-month extension. Okay. All right. So when you do your filing, the paperwork, that is retroactive. Okay. The thing about doing things retroactively is we have all the facts. We know what happened, right? So right now, as I'm recording this podcast, it is the year 2023, and the taxes that you are working on right now, they're the taxes for 2022. In other words, for the year that just ended, right? So we don't even start preparing our taxes for 2022, our tax filing, until 2023. Why? Because what we do is we gather up all the information, all the documentation about what we earned for 2022, and we put it together and we assemble with that information a tax return. So essentially what you're doing with that tax return is you are calculating all the tax you paid in already throughout the year, whether that came through payroll withholding from your W-2, from your spouse's W-2, from multiple W-2s, or estimated quarterly taxes that you paid in throughout the year, okay? In other words, those things are prepayments on your 2022 taxes, tax you've already paid, okay? So what we're doing with the tax filing is we're looking at all the tax you already paid in 2022 for 2022, and then we're calculating what you actually owed. And this amount is going to wiggle every year, right? We don't know exactly where that number is going to land. Why? Well, I just referred to it because Congress may have extended some old credits we thought would expire. They may have not extended credits we thought would get extended. So you lose some credits. Maybe other things happened in your life that might raise or lower your taxes. Maybe you had a baby, so now you have an extra child tax credit on your tax return for the year. Maybe you bought a house, maybe you got married, maybe you got divorced. So lots of things could happen in the year that would also change the tax you actually owe during the year, right? Maybe you sold a whole bunch of capital gains securities. Maybe you bought a house, right? Okay. So what we do with a tax return, with a tax filing, is we reconcile the tax you've already paid versus the tax you actually owe. And the ideal for every taxpayer is you want those numbers to be pretty close together. You're hoping your prepayments equal roughly what you owe for the year. Now, usually they don't equal it exactly, and that's okay. That's where you get either a refund if you overpaid for the year, or you owe a little money and you get a tax bill, right? A tax bill is your unpaid balance, which you settle up by April 15th. Okay, so that's how taxes work, your tax filing, and that is retroactive. In other words, you have 100% of the facts and you have total clarity and visibility, and you can get the number exactly right. In fact, that's the role of the tax filing. It is the time that you settle up and figure out what the exact right number is. Okay, so what I think happens, this is my theory here. What I think happens to people is I think that you think of taxes that way. You think of all taxes as working that way, of giving you an exact number, a number you know is accurate. And here's the thing, estimated quarterly taxes do not work that way. They're fundamentally different in nature. So what are estimated quarterly taxes? They are not a retroactive settling up of the exact amounts. What estimated quarterly taxes are they are a pay-as-you-go mechanism for people who don't have withholding, right? So if all your income and your spouse's income is on W-2s, somebody's running payroll and somebody is basically withholding tax on your pay throughout the whole year. So you are prepaying tax as you go along. You don't even have much choice about it, right? So you're pretty much settled up. People who are employees basically have very simple taxes because you're settled up most of the time. That doesn't mean even your numbers are completely correct. You still have to file a tax return and say what the actuals versus the expecteds were, and then settle that number. But for those of us who earn income that doesn't have withholding, that can't have withholding, and that could be because you're a small business owner, so you generate your own income. It could actually be for other reasons. You could be a farmer. You could be a real estate broker, selling buildings, getting large chunks of money when there's a sale of a building, right? So this is actually a large group of people. It's not just people who are self-employed, but certainly those of us who are self-employed are in this camp. So estimated quarterly taxes are our way of being able to prepay our tax during the year as the year is happening, not after it's over, so that we have settled up our tax bill before the date comes, before April 15th comes and the whole thing is due, right? The point really is to keep you out of hot water, right? It's to keep you from owing a full annual tax bill all at one time, because that can be terrifying, right? Even if you were setting aside the number, but your calculation was wrong, and you have a full annual tax bill that is far larger than you thought it was, well, you can get in huge trouble then, right? You can just face a bill that's much bigger than you can handle. And then we start having to deal with making payment plans with the IRS and tax debt. Yuck, you don't want that. And the IRS doesn't want that either. I mean, they'll do it if you need it, but we would rather you just pay the tax you owe when you owe it. So estimated quarterly taxes are not retroactive. They are real time. They're how you do your taxes as you go throughout the year. That's the point. Okay, so the fact is, as you pay them, you pay for the first quarter, you have no idea what's going to happen the next 3 quarters of the year, right? You have no idea. And neither do I, and neither does your accountant, and neither does the IRS. That's not your fault, right? It's just the nature of time, right? The nature of not having a crystal ball. And there's nothing wrong with that. So you have to make an estimate. You have to have some basis for calculating something close-ish. But I'm here to say, even if you're off by a lot, it's still better to be making some kind of a payment each quarter when you know that you are at least supposed to be making quarterly payments. It's better to pay something and be kind of wrong, kind of off, and to adjust it than it is to just get so scared and all up in your head that you don't do anything at all, because that's the one where you are guaranteed to get 4 penalties on each of the quarters that goes by where you didn't make a payment, plus daily interest on your unpaid balance. Okay. This is the scenario I was painting where I see a new client come into my practice. I look at their tax return. I see that they're paying a large tax bill every year and that they've been paying penalties and interest every single year without really understanding why they're paying penalties and interest, right? Possibly they might not even be looking at their tax return and they might not even notice it's there. So to me, it's my job as an accountant to point out when there are penalties and interest and say, this is what is causing that, and this is how you can stop that from happening in the future, right? The fact is, our tax code is built around incentives. Some of the incentives are positive and some are negative. So when you have penalties and interest, it's actually trying to tell you something. Like, you're doing something we don't want you to be doing. Here's how you can not have these penalties and interest when you stop doing that thing. Okay. So how do we make our estimated quarterly taxes as accurate as they can be, right? So we know you can't get the number perfect. That's never going to happen. But what can we do to get them in the ballpark, which is the goal? Okay. Well, there are actually some guidelines by the IRS, which is really reassuring. So we call these safe harbor rules. There are not 1, but 2 different safe harbor rules when it comes to paying your estimated quarterly taxes. So I'm going to explain those to you now. When you meet one or the other, it doesn't matter which one, if you meet either one of the safe harbor rules, what does it mean? It doesn't mean you've paid exactly the right amount of money, right? Because the IRS cannot just hand you a crystal ball and be like, we could see the future, here you go, right? That's not how it works. But what it does mean is this is what we consider to be a good enough estimate, right? And if you meet this good enough bar, we will not give you any penalties and we won't give you any interest. And even if your estimates, because, once you've met these safe harbors, even if your estimates after that are completely radically off the number that they should be, so long as you met one of these safe harbors, there's no punishment. Now, you will still have to settle up your tax bill. Like, we don't just forgive your taxes because you showed some good faith and made some prepayments. No, you still have to pay what you owe, which is fair. But there's no punishment. There's no penalties. There's no interest, so long as you meet a safe harbor rule, one or the other. Okay, so what are the safe harbor rules? Number 1, now this one is the one that is the easiest. So if you can use this one, this is where I recommend you start. And the thing with estimated taxes, it's really important to understand, is you have to actually really look at them over time and see if they are accurate enough and tune them up as you go. So this is one of the reasons that I say in my program to my students, perfection is impossible. Don't even bother trying. Just aim for improvement. So what you want to do with your estimates is look back at the year that went by before, look at the estimates you paid and see, well, was that radically overpaid? Was it radically underpaid? Was it kind of close enough? And you want to just make some kind of adjustment the following year to be like, okay, well, if I overpaid last year, I could probably dial down these payments and pay a little less and I'll probably be fine. Or could go the other way. I underpaid too much last year. And so now I'm going to have to bump up my payments this year, right? You want to make sure you keep looking back and adjusting. And that is how basically you start to improve over time. And you will find that you start having an intuitive sense of this the more you do it, right? You practice 4 times a year. So, in 3 years, you'll have done this 12 times. You'll get some experience. Okay, so safe harbor rule number 1, is, for one thing, the reason that it's the easiest one is it's based on last year's tax numbers. So it's in other words, it's a number you can actually know. You can actually look it up and you can actually do the math and you can feel some security that you 100% know that you're meeting the safe harbor threshold. This is why that's the one your accountant will calculate for you by default. Okay. That is the reason. So if your accountant has produced vouchers on the front of your tax return, which are part of a tax return where the client owes quarterly taxes. So these are automatic. Almost always, unless you had some consulting with them where you adjusted these payments, almost always this number, the number on those vouchers on the front of your tax return, are going to be based on this rule. Rule number 1, safe harbor, which is if you pay 100% of last year's tax this year, broken up into quarters, then you have met safe harbor rule number 1. Okay. Now this rule works pretty well if your income remains relatively stable one year to the next. Okay. So if you make roughly the same income this year that you made last year, then basing this year's taxes on last year's taxes is going to be fairly accurate. And that's why this one works. And this is why it's the one your accountant will do for you. So let's just illustrate how this one works. And then we're going to mess it up by talking about a scenario where it might not work. Okay. So how this one works is you can literally go pull out last year's tax return, look at your total tax. Now be very careful. You are not going to look at your tax due because remember, that's just the amount you're settling up. That's just your unpaid balance. You want to look at the whole tax you owed for the year. And you're going to take that number and you divide it by 4. Now, why am I dividing by 4? Because this is a quarterly payment that you're coming up with, right? A quarterly payment amount. So I'm taking last year's full tax, dividing it by 4, and that number is going to be the amount of quarterly payment that I will make each quarter going forward from this year, for this year. Okay. Now, 1, 2, 3, 4, when I add those all together, it should equal last year's total tax, right? So 100% of last year's tax, I did pay in throughout the year in quarters. And so check, I did it. Okay. Does that mean I paid the right amount this year? Again, no, it doesn't, because these are estimates, right? So you may still have overpaid, you may still have underpaid. So you'll have to settle up. You'll still have to file a tax return to show sort of what you prepaid in estimates and what you actually owe. And you'll do some settling, right? You maybe will settle up a little bit of a bill, or you will get a refund if you overpaid. Okay. So that's the easy one. That's the one. If you're brand new to this, that's the one you probably want to take home with you and try for yourself. Now, there's a second scenario, which if you're working for yourself, if you're a solopreneur, if you're a creative person, you will recognize this scenario. Let's say that this year, shit happens. It could be that you had a baby and you are taking some time for maternity, paternity leave, parental leave, I should say. It could be just that sales flopped, like you did a big experiment and it didn't work. It could be that your show didn't sell out, or that a grant that you used to get all the time you didn't get. So if you have a big drop in income this year, then what happens when you try to pay your taxes based on last year's tax? Well, for one thing, you'll be paying a much higher amount of tax than what you're actually going to owe, because you can basically assume when your income goes up, your taxes go up. When your income goes down, your taxes go down, right? So when you have a massive drop in income this year and you're basing your tax payments on last year's tax, you are way overpaying your taxes. And when you have a year like that, you probably need the money, right? So there is a second safe harbor rule, which is built for us. It is built for that very scenario. But here's my warning, it's much harder to use. And this is why it's much less common. So the second safe harbor the second safe harbor threshold says you can pay 90% of this year's tax in this year in quarters. Now think about that for a second. How do I calculate 90% of this year's tax? Here I am recording this, it's February. I don't even know what's going to happen for the next 10 months, right? Like, what? So the fact is, You cannot do this based on the full annual income. You can't make a calculation the way you can when it was about last year, which is over, right? We're now talking about the present and future, okay? So what's 90% of your present and future income? Well, now we're in the twilight zone, right? Now you have to guess a little bit, you have to calculate a little bit. And here's the real answer. What you really need to do is you need to do bookkeeping. You need to actually have bookkeeping set up, be tracking your income, be tracking your expenses, and be calculating what your profit is at a minimum each quarter. Now, when you know your books, when you do your books each quarter and you know what your profit is for the quarter, you can treat your profit in your business like your taxable income, right? You can assume that that is the amount that is taxable. It's not perfect. There will be some little slight differences between your taxable income and your profit in your business, but they'll be very close. And so you make a calculation based on your profit, okay? Now, this one can get a little tricky. I'm not going to lie to you. There's some strategy. You certainly want to account for the self-employment tax that you owe. So you know you can multiply your profit by 15.3% self-employment tax to figure out the amount of self-employment tax you owe. And that is going to overshoot it just a teeny bit because half of your self-employment tax is actually deductible. And then you also need to estimate what your income tax is going to be on that profit, which is an even harder number to come up with. You might want to go find your average tax rate, but you do need to be careful that that average tax rate does not include your self-employment tax rate lumped inside it, or else you'll be way overshooting the number. So there is a lot of nuance around calculating this number, and I don't want you to get lost and confused in the details here. There are quite a few details. It takes some getting used to, it takes some education and some practice. And also PS, I do all that education and practice inside my program, Money Bootcamp. But what I want you to take away if you're listening right now is this rule can help you because it can allow you the leeway to pay in a lesser amount when you're having a harder year, when your income is not as robust as it was the year before. Also important to understand, there's no assumption baked into this second rule that your payments will be equal each quarter, and they don't need to be. You might make a lot of income in the first quarter, virtually none in the second, virtually none in the third, and then a ton in the fourth. Actually, that's pretty normal for anybody in a retail operation, right? Think about a craft artist whose primary source of income is holiday sales. And you're not alone. The Gap has the same pattern at a much larger scale. So you can calculate using good bookkeeping. You can calculate what this number is each quarter as you go. So you basically just keep doing your books each quarter and make a real-time calculation for what you're going to pay in estimated quarterly taxes that quarter. All right. Now, the other thing I want you to remember is that states have quarterly taxes too. Not every state will penalize you with penalties and interest if you don't pay quarterly. Some states will allow you to pay annually, but many require quarterly payments. So you should assume that your state does require you to pay quarterly, and it's also just better for you to pay quarterly so that you're breaking up the bill into smaller parts. We don't want you having big unexpected tax bills in general at the state or federal level. Okay, and then lastly, where do you actually pay? So you're going to make your payments online at IRS Direct Pay. So you just go to irs.gov and there's a button that says make a payment, and you just go there. It will bring you to IRS Direct Pay. Make sure the site is .gov. That's very important, not a spoof scam site. And you just make your payment there. And in the little pull down menu, because some people get confused here, you're going to click 1040 ES. ES stands for estimates. You're not paying last year's taxes. No, you're paying this year estimates. All right. Okay. So hopefully that got your head around what quarterly taxes are, why they're different from paying last year's tax bill. And I am hoping that from this episode, you understand the basics of how to estimate and pay what you owe as you go, okay? And also that it's important not to wait, right? Don't let perfectionism stop you from making any payment at all, because the only thing that does to you is guarantee that you will be paying penalties and interest. Now, these don't get calculated until next year's tax return. And that's such a big lag time that a lot of us don't connect why those are there on this year's tax return. But it's because you didn't pay your quarterly taxes on time last year. All right. So I hope that this episode has taken that fear, that perfectionism out of this process and made you realize that this is something you can do. And maybe that you need to be doing. And so if you want to do that safe harbor rule number 1, you have everything you need right now to just go right ahead, pull out last year's tax return, look at last year's total tax, make that quarterly tax payment calculation. You can do that right now. You can get started right now. And if your income is less even, if you get income the way that many small businesses and creative people do, which is lumpy and irregular and not the same every month, and you need more accurate payments to stay on track, this is something that I do teach inside my program. So if you want to learn more about the program, I will be talking more about it in a live class that's actually coming out this week. So I'll be hosting a live masterclass on the 15th of February. I'm going to be showing you the exact framework. So this will tell you what the things are you need to organize your money and organize your systems for taxes. I will be showing you what the framework is that I use inside my program. And I will also be showing you how inside my program, each of these modules is structured and what you get out of doing each one. So after module 1, you will have this. After module 2, you will have this. You will be able to calculate your profit, calculate your estimated payment, etc. Okay. In the class, I'm also going to be telling you a very vulnerable story about why freelancers and creative people having money is so important personally to me. And I'll be talking about some common mistakes that I see people make with their money and how you can avoid them. And like I said, I will be teaching you this framework that you can use right away. Or if you want the tools and resources specifically that I teach inside my program with them, you can learn more about how the program works and how you can sign up. So this class is free. It's offered this Wednesday at noon East Coast time. There will be a recording, but I do a Q&A on the live sessions. So come live to be able to ask your question. The class is free, but you do need to register. So to register for the class, it's called Understand Your Taxes and Make Money, the ultimate guide to the hard parts of self-employment. Obviously, one of those hard parts is your estimated quarterly taxes. All right, so you can sign up at go.sunlighttax.com/free. So sign up for this class at go.sunlighttax.com/free. I hope to see you in this live class. I hope you got a lot out of today's episode. Please like and share it if you did. And I hope to see you live in class this week. Thanks so much, everybody. Bye.